In today's video, we are going to take a look at Nvidia, which is probably one of the hottest tech stocks at the moment. But is their steep valuation justified? Can the company grow? And is it maybe even a decent stock for dividend investors? This is Might As Well Invest becoming smart money. On a side note, only a small portion of you that watch my videos are actually subscribed or end up smashing the like button. So if you end up liking this video, consider doing both of these, as they are free and you can change your mind at any time. Now enjoy the video. Nvidia, which was founded in 1993 and is headquartered in the US, is one of today's biggest information technology companies on the market, pushing the development of visual computing technology, which is used in the gaming segment as well as in the data server segment, further and further. But more on all of this later on, after we've taken a look at Nvidia's market cap. This currently sits at about $323.2 billion US, which is actually very sizable if compared to companies that do the somewhat same thing. But obviously the revenue of the last fiscal year also plays a somewhat decent role in the valuation of Nvidia. For the year of 2020, which is their last fiscal year, I know it's a little bit weird, this sat at about $10.9 billion. However, let's break that revenue down a little bit further, so we can get a basic understanding of what is going to drive Nvidia going forward. The company's biggest segment is the gaming segment, contributing $5.5 billion to the overall revenue. This is then followed by the data center segment with about $3 billion US in revenue. In the third place, we have the professional visualization services, contributing $1.2 billion. And last but not least, we have the automotive as well as the other segment, with about $1.2 billion US. But enough with the brief introduction. Let's get to the interesting part, which is the distribution of cold and hard cash to the company's shareholders. Nvidia currently returns capital to its shareholders through dividend and stock buybacks. But let's start out by taking a look at the dividend, which currently sits at a fairly small 64 cents. Equaling a low yield of just about 0.12%. Pair this with a dividend growth of 8 years, which is also when the company started paying a dividend, and you get the prototype of a tech stock. What I, however, find somewhat untypical for a tech company, which usually tends to have a low yield, is that for the case of Nvidia, the 5-year growth rate is lagging a bit behind, with just 10.13%. When it comes to stock buybacks, these are a little bit harder to track. If we, however, take a look at the most recent results, we can see that there were no stock buybacks in 2020. And for the years before that, it used to hover around the 800 million mark. But let's also have a look at the numbers and check out how much Nvidia actually returns to their shareholders and how sustainable these distributions are by comparing it to Nvidia's free cash flow. Here we are able to observe what I consider to be the ideal free cash flow trend, with a pretty appealing growth throughout the years. When put into contrast with the distributions, it is also fairly easy to say that these are more than sustainable, and we can likely expect distributions growth for the coming years. But let's take a look at the balance sheet to see if our thesis can already be confirmed. In the year of 2016, Nvidia had about 7.3 billion in total assets. These were made up by about 4.4 billion in equity, 2 billion in financial debt, and 846 million in non-interest paying capital. To evaluate this even further later on, we would now calculate the net debt, but since Nvidia held about 5 billion in cash, this turns out to be zero. If we now compare this to the year of 2020, we can see a hefty increase in total assets to about 17.3 billion US. These were made up by about 12.2 billion in equity, 2.2 billion in financial debt, and 2.8 billion in non-interest paying capital. To again further analyze this, let's calculate the net debt for the year of 2020. And well, with Nvidia's cash position of 10.8 billion, this again turns out to be zero. Usually at this point we would calculate how sustainable the debt of Nvidia is, but since there practically is no net debt throughout the years, we can simply skip that step. Alright, so since we now have the financials covered, we want to get the margin of safety, as this one helps us with evaluating the company later on. First of all, in my opinion, it is pretty important to point out Nvidia's brand. They are pretty much the go-to name that you are recommended when looking for a GPU. If I, for example, go back to just a few years ago when I was building my own computer, Nvidia was almost instantly recommended to me as the cutting-edge technology provider for whatever you're looking for. And well, like a lot of others, I went with Nvidia, and I could not complain less. For this reason, I will reduce my margin of safety by about 5%. But obviously, I'm not the only one that thinks so, which probably also is the reason why Nvidia owns round about 80% of the GPU market. To be honest, this also somewhat leads me to the conclusion that Nvidia does not really have a huge competitor, as even AMD can not really hold up with them. Combine this with the fact that during the pandemic, more people were looking to game at home and therefore had to expand their setups, and you get a situation where Nvidia actually ran into issues of shortages for their GPUs. This, in my opinion, is probably in the future also going to lead to something which I consider to be a very decent cash flow. Therefore, I will reduce my margin of safety by about 10%. Last but not least, I have to say that we are most likely going to see a very similar trend take place in the data center segment of Nvidia. Here they just delivered some new products which experts deem to be quite useful, especially in the coming AI developments. For this reason, and since the world is growing more digital in general, and thereby relying more on data centers, I will be reducing my margin of safety by another 10%. But obviously, Nvidia isn't perfect. However, I do have to admit that when researching the company, I basically found close to no downsides. But since I'm obviously here to dig up all the tiniest of dirt, here's what I found. Nvidia does not manufacture their products themselves, but instead leaves this process to Samsung as well as Taiwan Semiconductors. While these are very good manufacturers that also help reduce costs for Nvidia, there's one thing that I think can be quite problematic, and that is that you actually have less power to maneuver in a situation like this pandemic, since you have to rely on your business partner. While I think this is not a huge deal breaker, I'll still add 5% to my margin of safety. To now get the fair value of Nvidia, we have to take a look at the historic dividend yield. For the past 8 years, this sat at an average of 0.83%, thereby meaning that you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of 64 cents, a fair price to pay would be $77.10. This would mean that you currently would have to pay a 577.3% premium, with the share price of $522.20. Note, this is only in respect to the dividend though. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 0.83% and add my safety margin of 5%. This gives us our target yield of 0.87%, which leaves us with a price to buy the company at of $73.56. To sum it all up, I must admit I was genuinely surprised about the fact that there is no huge downside to Nvidia. Should I rely on others to do a large part of the actual manufacturing work? But hey, that also worked out pretty well for companies like Coke. And I'm sure it can be also a huge driving factor in the future growth of Nvidia, which I also think is pretty certain with the world growing more and more digital. But is Nvidia valued fairly? Well, that depends on what perspective you are looking at the company. If you are a regular dividend value investor, I personally would say you should not buy Nvidia, but instead hold on to the shares if you already have some. If you, however, are a more growth-oriented investor, I would say that Nvidia is somewhat fairly valued in respect to its competitors, and thereby could offer some upside. This was mine as well. I hope you enjoyed the video, and I'll see you in the next one.